lending's not perfect, investing's not perfect, and so you have to lead with what your biases are to know how to best invest, right? So my bias is I'm historically an operator. So when I speak to a sponsor, I don't want to talk about we're gonna do brown paint color versus gray, or that's, what does the asset look like? What are the bones of the building? What does the neighborhood feel like? Have you talked to the 3 neighbors? Have you went and secret shop those as the sponsor, not the management company or someone else? Did you put your feet on the ground? Did you stay the night? Like, are you buying a $20 million asset, and did you stay the night in the neighborhood and see if it was something that's interesting and appealing to your potential residents? And so it's something you can very easily kind of feel in a conversation. But I think that the folks that have that mindset of really digging into the asset itself, not the economics. The economics flow from knowing your asset. And I feel like we kind of had it backwards a little bit for a while.
Hi, Adam Gower here, founder of Gower Crowd and host of the Real Estate Reality Show on YouTube and good podcasts everywhere. Thanks so much for joining me today. My guest today is Scott Larson, who is managing principal at Pangea Mortgage Capital. Now, I saw an article in Wealth Management Real Estate that quoted Scott quite extensively. The title of the article, of course, I forgot this when I spoke to Scott, but the title of the article is How Lenders Are Dealing with Distressed Commercial Real Estate So Far. What you're going to learn from Scott today is that he is a balance sheet lender. You're going to find out exactly what a balance sheet lender is. And he talks about what he sees particularly in the multifamily space. He shares some very interesting insights into what's going on with, and what he's been seeing actually over the last few years as many multifamily sponsors have come to him for capital, for debt on their projects. He does both value add and also ground up multifamily. And he talks about some of the mistakes that he's seen that have been made and what makes for an exceptionally good sponsor. It's a very interesting conversation. He is as close to the ground as you will find anybody in this space. If you want to know more about Scott, go to the podcast page at gowercrowd.com. And while you are there, be sure to subscribe. If you're not already a subscriber to our weekly newsletter, it's totally free. And we cover the world of real estate, syndication, and crowdfunding. We send out a list of all the articles that we find that are interesting, and we have some commentary there as well. You'll find it useful, I hope, as you navigate the market that we see today. And we're also actually focused on what's going on, particularly with distressed real estate, how the market is playing out. All there at gowercrowd.com. All right. Thank you so much again for joining me. Let's turn it over to my conversation with Scott Larson over there at Pangea Mortgage Capital. Scott, thanks so much for joining me today. Yeah, you're more than welcome. So I'm really glad to have you on the show. I read a very interesting article in Wealth Management Real Estate. Of course, now I can't remember the title of the article. It doesn't matter though. We're going to talk about everything that you discussed in there. And I'll include a link to it in the show notes at gowercrowd.com. So anybody that wants to read the full article can do that. But let's start with this question, if you don't mind. Before we get into the nitty gritty, I noticed something in that article that mentioned that Pangea, is that how it's pronounced?
Pangea.
Pangea.
Supercontinent, Pangea.
Pangea, okay. Pangea Mortgage Capital, that's the company of which you are a managing principal, correct?
Correct.
Is a balance sheet lender. So let's just start at the very, very top for that one person who's watching today, doesn't know what a balance sheet lender is. What's a balance sheet lender? How does it fit into the financing world of banks and insurance companies and whatever else? Let's start with that, and then we'll talk about the nitty gritty.
For sure. A balance sheet lender looks and feels a lot more like a bank than what a lot of folks are more accustomed to, which is securitized products. So when we raise capital into our enterprise. We have a large balance sheet that we deploy our loans on. So you know that all of our loans live here. Whereas in many cases, especially in commercial real estate, they go through, your loan will originate with someone, but then it'll go through a securitization process. It'll get packaged together and sold off to bondholders. And probably, one of the simpler examples to it is if when you have a home mortgage and then there's suddenly a new person owns the mortgage and there's a new servicer, that's very consistent in the securitization market. Whereas we don't do that. Everything stays within our four walls.
Right. So you're technically you're investing your own capital. Is that right?
That is correct.
Yeah, it's your capital. And do you ever sell those loans, or do you really hold them on the books all the time?
We really hold them on the books. We will sometimes bring in for larger loans some of our limited partners that want a more exposure to them, where they can have the opportunity to buy into a loan for more. But no, we don't sell off our loans.
Right. So, and how do you compete then with other financial institutions, like with banks?
Banks is challenging. Banks is a whole different ballgame. I think when you look across the CRE spectrum, you start in the banking world, which is, it's obviously different today than it was 12, 18, 24 months ago, but it's a low levered opportunity for the banks to provide often recourse to sponsors. And there's a heavy reliance on low leverage and typically a treasury relationship. So they're looking for their borrowers to have cash in the accounts with the bank. Because obviously, as we learned from the SVB crisis, deposits are critical, right? As you move your way through the CRE spectrum, you start to deal with private balance sheet lenders like ourselves, as well as groups that securitize their loans. And so how we compete is we are typically providing more leverage to sponsors than banks. We're frequently non-recourse. We're more often than not, banks are recourse. And then because we're not regulated like a bank, and we don't securitize our loans and sell them off to bondholders, we have the ability to create a really custom solution because it's living on our balance sheet. So if we're okay with it, and it doesn't need to necessarily fit perfectly within a box. And so that's how we compete.
And are you regulated in the same way as a bank or not?
We are not. Limited regulation.
And are your loan rates typically higher than a borrower can get from a bank?
Yeah, so we're anywhere from 200 to 400 basis points or percentage points higher than your typical bank. So if banks today are 7-8%, we're more like 10 to 12%.
And are you called a mortgage bank? Is that what you're called? What are you called? Like, what's the genus that you operate in?
Private balance sheet lender is really what we are.
Oh, the simple term, right?
Simple terms, yeah. We don't even want to use the word bank because that introduces a whole different host of complication. We are not a bank. So. Yeah.
And how much leverage? You mentioned more leverage. So typically, what kind of leverage will you offer?
So if you look at the landscape today, we do a lot of ground up construction. For example, banks, if they're willing to lend, are going to be more in the 55% loan to cost to 65% loan to cost range. We're typically more like 65% loan to cost to 75% loan to cost. So, we're easing the need for equity to come in, but in our belief, based on our experience, we feel protected. And that additional leverage is what justifies the increased pricing that we charge.
Now, what this also means, if you're a balance sheet lender, is that you are servicing the loans directly. So you have direct relationships with your sponsors and you have relationships with them.
Correct. I am in the next 3 weeks, I'm going to be at 5 of our projects that we've already have loans on. We meet with the sponsors quarterly. We walk the project. We see how things are going. We assess the market again. But to your point, we touch the project from A to Z.
Right. So you have direct vision, direct line of sight on what is going on in the market. And one of the comments that you made in the wealth management real estate article they quoted you about was this. I'm actually going to read it to you.
Okay.
I'm going to read back your own quote. So there's a lot of talk about office, you said, but people are going to be surprised about the disruption they see in sectors such as multifamily that people were not expecting. Tell me more.
Yeah, I mean, it sort of feels like when you go, the commercial real estate market right now, it sort of feels like when you go into an awkward conversation, you start talking about the weather. Right now, everyone just talks about office, right? They're like, ooh, office is bad. Like that's the immediate beginning conversation that people have. But I don't get me wrong, office is challenged right now, for sure. But there are significant other challenges we're seeing in the market. And we're starting to see distress in the multifamily market. But also, at the end of the day, you just have to look at the numbers, right? So between now and the end of 2025, it's approximately $1.3 trillion worth of commercial mortgage debt that is maturing. And then starting in 2025 through 2027, you have another 1 to 1.2 trillion, and half of that is multifamily. And so you have folks that bought deals that had a business plan that maybe they're on their way, but they're not there yet. This is a good scenario. They're going to be challenged to get refinances, much less the people that didn't. And so if you just strictly look at it from a numbers perspective, that absorption is going to be enormous, not just for office. It's going to be for groups like multifamily as well.
All right. So the counterpoint that I read about with multifamily is that, so, we bought in 21, we bought 2 years ago, but we saw, 20% increase in rent. So we were able to offset this. What are the mechanics of what's going on in multifamily from an economic perspective that you're seeing that leads you to believe there's going to be more trouble than people expect?
Sure. By the way, my heritage is, our parent company owned and operated 13,000 apartments. I personally have been in probably 40,000 apartments in my career. And so I feel like we know the multifamily space well. And I agree with folks that say that it's more protected because of the rent growth than you've seen elsewhere. Mm-hmm. But I would challenge a little bit the concept that when you talk to someone that has a multifamily project right now and they're a little bit upside down, so maybe they bought a 4 or 5 cap, their cost of debt right now is a 6 or 7 cap, and they say, well, we just need time. And with time, rates will come down. And I agree, I hope. But my counter to that statement is sure, but that also implies that there's a potential recession there. And so all the rent growth you've seen may have gone away. And so your cap rates may improve from where they are today, but you may also lose some of that rent trajectory that you were just describing. And what's not changing is a big chunk of the expense side of multifamily. So I don't know a lot of municipalities that are going to cut property taxes in the next few years. Insurance is more expensive, unfortunately, because of some recent events. And so, you really do have a pretty heavily fixed portion of your cap stack on the expense side, and we'll see where rents go. TBD.
So you see, obviously you don't finance everybody that comes through the door, right? Yeah. So of the deals that you've seen coming across your desk over the last few years that you've passed on, mm-hmm. but that have perhaps been financed somewhere else, what have been the biggest, I want to say mistakes, but the red flags that you've seen in the way that sponsors over the last couple of years, and you do primarily ground up, right? You don't do value add?
Well, we do value add as well. So we do a mixture of lease up plays, value add, and ground up.
Okay, so across that spectrum, what have been the biggest surprises that you've seen, or the biggest red flags that you've seen over the last 2-3 years on deals that you've passed on? Hopefully the ones that you've passed on.
Right. So I think that we need a little bit of a reset in the specific to multifamily when it comes to the concept of acquiring an asset and putting limited amount of work into the asset. So whether, 10 years ago it was when you bought an asset and you said, I'm doing value add. People said, oh, you're redoing the kitchens and the bathrooms and you're replacing everything. Then 5 years ago, I kind of felt like we're replacing the kitchens. We're going to make the kitchens nicer. And then in the past 2 years, it's been, we're going to repaint the unit and we're going to raise rent. The continuum of improvement has changed. And so I think as it got towards the end, I think a lot of folks were really betting on minimal value add and still an increase in value. And so we really struggled with those underwrites that say just throwing a new coat of paint on probably isn't going to add 15% to your revenue growth. I think the world kind of needs to get back to where we were. And so that was a big red flag for us. And then the other thing was folks that did not know the assets inside and out. You sort of felt like you were dealing with folks that were they were allocating capital more so than thinking like an operator. And that's just
interesting. I'll tell you what. So look, I definitely want to drill down on what does that mean exactly? Just talk kind of, let's unwrap that idea. Allocating capital rather than thinking like a sponsor. What does that mean exactly?
So, lending's not perfect. Investing's not perfect. And so you have to lead with what your biases are to know how to best invest, right? So my bias is I'm historically an operator. So when I speak to a sponsor, I don't want to talk about we're gonna do brown paint color versus gray, or that's, what does the asset look like? What are the bones of the building? What does the neighborhood feel like? Have you talked to the 3 neighbors? Have you went and secret shop those as the sponsor, not the management company or someone else? Did you put your feet on the ground? Did you stay the night? Like, are you buying a $20 million asset, and did you stay the night in the neighborhood and see if it was something that's interesting and appealing to your potential residents? And so it's something you can very easily kind of feel in a conversation. But I think that the folks that have that mindset of really digging into the asset itself, not the economics. The economics flow from knowing your asset. And I feel like we kind of had it backwards a little bit for a while.
Yeah, that's interesting. So knowing the asset. So in other words, I'm just going to try and reframe what you just said. It's actually understand the asset itself rather than working the asset via or seeing the asset only through a spreadsheet.
I think that's right. I think it's a good way to perspective. Yeah. Because if you're doing it vis-a-vis a spreadsheet, it starts to feel more like financial engineering than it does operating an asset. And what's critical is in times like these, financial engineering isn't going to get you out of challenges. Operating is going to get you out of challenges. And so, because you can't financially engineer right now, it's not possible, right? So you have to work it. You have to work the project. You have to be thoughtful and creative. And I give a ton of credit to our current sponsors. They're doing all sorts of interesting things to drive lease up and to be really aggressive and thoughtful. Things you hadn't seen in the last few years because you didn't need to. And
like
now,
what, for example, what kinds of things, Scott?
So, they'll do things like they'll offer rent promos, but it's not just 1 month free or a month and a half free. They'll say it's a month free if you sign up in 48 hours. We'll give you another $500 and we'll give you a $200 gift certificate to the restaurant that's at the bottom of our building, right? And so you're increasing that interaction and thoughtfulness with the tenants, not just giving them money, right? You're trying to really drive thoughtfulness. And by the way, it's really smart because then you're bringing them into the building. They're having dinner in the building. All of a sudden, they start to grow an attachment to where they could potentially live and say, oh, I could do this on a Friday night, right? Or they give them a gift certificate for the dry cleaner down the street and say, go and try that. See what you like about the neighborhood or a cup of coffee. It's those types of things that you didn't have to do before, but they're going to make all the difference over the next 2 years.
Fascinating. And the other thing that you mentioned was, which speaks directly to this, was this idea that some of the sponsors that you saw, and again, I don't want to put words into it. I just want to try and paraphrase what you said, but that some of the sponsors were operating their businesses or their buildings remotely. In other words, their business plan was buy a building, hire a management company, and let them do it.
Right.
Yeah. So what is are there any, did you see a lot of that kind of remote operations and can it work? And like, what are the biggest problems with doing it that way?
So anything can work as long as it works. It's fine. You can run an operation remotely. You can have assets in multiple geographies and locations. And I am a firm believer that if you hire good people, you can utilize them and leverage them, and you can be successful. Where I think the remote concept gets challenging is times like these, right? Where every little bit matters. And for me, as your partner in the deal, as a lender in the deal, if we're having a challenging conversation, my first question is, so where are you today? I would just like to know, are you on the beach today when we're talking about, or are you at the asset? When was the last time you were there? How did that go? So don't get me wrong, everyone, we have plenty of sponsors that have assets in many geographies, and you don't expect them to be, every single day of their lives living in these assets. But as you start to identify problems, their engagement will tell you the likely outcome, in my opinion. And again, knowing my own bias.
It's extremely interesting you say that. One of our inner circle members, and we have this group that meets actually every Thursday at noon, told me he saw an asset in Texas, sorry. The bank had introduced to him, and when he went to visit it and spoke to the management company, so the bank wanted to get rid of the loan, actually. Okay. The management company said, yeah, they hired us 3 years ago. We've not seen them since, right? Basically. Just not been there. It's crazy.
Yeah, and I think there's times where there's paralysis for folks, right? When things get challenging, they almost don't want to deal with it. And there's like an avoidance concept, right? And that part of what I talked about in that article was communicating, right? Like getting in front of one another, having video calls like these, speaking, sitting around a table. We've turned into very much an email culture. And I think it allows us to, when there's conflict or confusion, to kind of step back and try to avoid the situation. And instead, I think we've proven over time that it's the other direction that really ends up driving results, right? It's rolling your sleeves up, engaging all the counterparties, going to the asset, knowing the staff. By the way, if you're the owner and the staff knows your name, there's no doubt in my mind, and they like you, they're going to work harder for you, right? Versus the gentleman you just described who they've never met, they don't know. I'm sure they're still going to try very hard, but there's a level of personalization. And by the way, that's your asset. Like, you should want to be there, right? It should be important to you. So I think human engagement, I know we're entering a world of AI and many other things, but human engagement is critical, in my opinion.
Yeah, it's really interesting that you talk about this. It's one of the consistent themes that I've been hearing, especially about multifamily, is management. It's not a spreadsheet function. You can't just plug in a percentage, go and find someone and tell them to, 4%, whatever, we're going to pay a management company to do it. It really is. That is how you make money in multifamily, is effective management from day one and understanding what's involved at T-minus due diligence period before you buy, basically.
Right. No, you're right. You're right. And by the way, like we have plenty of case studies over the last 6 months and currently in our portfolio of really successful operators and managers who do that. I think in many, if not most cases, that is the norm. But I think we all maybe lost sight of it a little bit over the last few years.
Well, you say it's the norm, but just to kind of flash back on what we've been talking about, it's the norm for the sponsors that you have financed. But for those that you've turned away, it's not the norm, right? Would you agree? I mean, would you agree?
That could be the case.
Found capital somewhere else. Yeah. So the other thing that you mentioned was that they're capital allocators. All right, that's a very interesting concept. So where, as far as you know, from those folk that you've turned away politely for whatever reason, but because you've thought that they were capital allocators, at least at a high level, where did they get their capital from? Where's this capital been coming from? And have you seen that any trends, especially in these operators that maybe don't have the same kind of management experience that you've been talking about?
They raise it from elsewhere, and elsewhere can be a whole host of other places.
You're talking about equity capital when you say
equity capital. Right. But they raise it elsewhere, whether it's distant friends or through whatever channel or methodology that they raise it. But it's not in a traditional method, meaning, it's not a private equity fund that we're talking about.
Right. So this individual investor, what I'm getting at is, are these, so everybody syndicates, even if you've got more than one equity investor, you've syndicated, you do.
Right.
But the term I want to use is crowdfunding. If are these folk that have gone out online and
Yes.
put up ads and banners. Talk to me about that and what you've seen.
Yeah, I mean, so we've seen whether it's through an official channel that you can find on the internet or elsewhere, or whether through it's a non-official channel, right? It's a pass the hat where a group of people, and it's people 4 degrees separated, and before you know it, you thought it was your 5 friends that were your syndicate partners, and now you have 140 friends, which I don't know many people that have 140 friends. Good for them if they do. And I think to some extent that is great. It's a great way to raise more capital and to expand your asset base. Where my focus then tends to come in is, okay, that's great. It doesn't always matter where you get your capital from. What matters is what are your interests? What are your alignments? And what happens to you if the deal doesn't go well? That's always my, what are the ramifications for a poor outcome? And if, by the way, the ramifications make sense, whether it's, I don't have a lot of money in the deal, but, my in-laws do. And I assume that's a big deal to most people to have their in-laws in the loan. Maybe a few folks that don't care, but, or it's, the same 10 people that are in this deal have been in my last 5 deals. That matters a lot, because that versus I'm raising from a blind pool. I don't know who these people are. And we'll see what happens. You tend to find that outcome isn't always the best.
And do you look at alignment of interest? Is that a kind of one of the metrics that you look at? It's very interesting that as a lender, you would look at that as well.
I mean, I have to, because the person on the other side of the table, to me, I need to know that when I text them or I give them, we're a very engaged group. So, we have phone call and text relationships with all our borrowers. Hey, how are things going? Do you need anything? Hey, we're going to be in Charleston next week. Can we swing by and say hi and have lunch? You need to know that the person on the other side of that communication is going to be responsive. And by the way, it doesn't have 7 other, maybe it's not even that things aren't going poorly. Maybe things are going great, but they have 7 other things going. And how do you make sure that you're in the top 3 and not number 7 of the 7 things that they have going on? And so knowing that they have an economic alignment on the project and why it's critical to them for success is important, because capital, I don't want to say capital is easy, but getting capital is not the challenge. The challenge is finding someone that has the capital, that has the right business plan, and that's going to be a good partner to you as the lender. That's the way we see it.
Extremely interesting, you say. I've never heard a lender talk these things. And again, I'm not going to disparage anybody that I've worked for and had the pleasure of working for before. So don't get me wrong with what I'm going to say now. But I did have experience working in a major bank during the last downturn, and then subsequently on the distress side. For Colony Capital, I managed or worked on a $7 billion portfolio of loans that had been bought with the FDIC, and they were all from failed banks. And the one thing that I never heard said was that we look for on the lending side, we look for an alignment of interest between the borrower and their equity. The security that lenders typically look for are the collateral, right? The debt service, and maybe guarantees. In your case, non-recourse, but maybe guarantees or bad boy carve-outs, whatever you got. That's the security. And that's probably more from the regulatory perspective. That's what they have to have. Right. And an appraisal and all this kind of, but the idea that the one component is, what is the alignment of interest between this sponsor and their investors? If they lose this deal, are they going to suffer any pain, right? In some way? Have they put their own money in, etc.? That's an interesting perspective.
It's important. Every project's unique. It has its own characteristics, and understanding, I'll put it differently. A good sponsor can make an okay project very successful. An okay sponsor can screw up a really good project. And so, understanding who they are and why they care about it and what drives them, to me, is infinitely more important than just the sticks and bricks.
Fascinating. Gosh. All right. So, I do want to keep it at 30 minutes. I would actually love to talk to you for much longer. But let's be disciplined on this and just spend a few more minutes. If you don't, we can definitely come back and chat again at another time. So I'm enjoying talking to you very much indeed, Scott.
Likewise.
Yeah. Let me ask you a couple of questions, though, just to kind of wrap up as we move that way. The other thing that you mentioned was, well, let's talk again. I'm just referring to that wealth management article. But one of the things that you referred to was the idea of, or discussed, was what are borrowers, smart lenders and smart borrowers doing today? One of the things you said was forcing themselves to the table now. So what's going on? What are you seeing, and what's going on today?
We're having conversations. So this is July, and we're having conversations about November and December right now, right? Like if we did our jobs correctly, we have the rest of the summer and the early fall. We know what to expect. We know what people are planning on doing. And by the way, we understand there's an error rate and things don't always go as you plan, but you can't live in a kind of a reactionary moment. You have to get in front of folks and say, okay, in November, this is what it's looking like. If rates don't change, this is what we see. There might need to be a capital infusion, or are you considering selling? If you are considering, have you talked to anyone? What have they told you? And so it's strange right now. So I'll put it differently. A year ago or 2 years ago when we did that, people were like, "What? Why are you calling? Is there a problem? I don't, is there something that I should be worried about?" We're like, "No, this is just what we do." And they're like, "Oh, okay." Now I think people really appreciate it, right? Because they're worried too. Sponsors are worried, counterparties are worried. And so being much further in front of things is actually, I think, a pressure release valve for a lot of sponsors, because I think they're bottling up. They're worried about it, but they don't want to talk to their lender about it, right? They don't want to say it. So you being the one that opened up the conversation, say, it's an open dialogue. Let's just start now because it's July and we got lots of time to figure this out and work together, versus it's October 15th and we have a November problem. Right. And we knew it and none of us wanted to talk about it. So that's how we're spending a lot of our time. And I think there's other folks in the space doing the same thing. Some are adopting it sooner than others, but I think people are trying.
It's really interesting that you say that. So one of the things that I've heard is banks are, I'm sorry, yes, some sponsors are coming to their lenders and asking to refinance today, even if they have more time on their maturities, and even if it's at a higher rate, because values, when you look backwards, which is how appraisals work, right? You're looking backwards at values. Values are still relatively high. So they're able to get those LTVs in place, get the debt in place against current values, because they anticipate the values are going to fall. And if they attempt to do this later in the cycle, they're not going to be able to borrow as much. Is that a strategy that you've seen? Of course, this speaks to DSCR. Sorry about that. Does this speak to DSCR as well?
It's funny you bring that up. We have had significant payoffs so far this year, which candidly surprised me because I know the lending market is uncertain right now.
Because people are selling, or because they're refinancing?
They're refi. They're overwhelmingly refi. Really? And they're willing, to your point, to take more expensive than they had anticipated bank debt, and say, I'm 1.5% or 2% higher than I underwrote, but I know I'm locked in for 5 years, and I just don't like this environment right now. And I think that is an incredibly smart thing to do in light of we just don't know. And so we're seeing a lot of folks trading out for that longer term product. Absolutely.
That's really interesting. And now, are you willing as a balance sheet lender to take much higher LTVs on refinances on projects that you've financed before, because the value has come down but the debt has stayed the same or close to?
So, we're by nature, we're a higher LTV lender. I think we're fortunate in that we always get appraisals. We think it's our requirement as a fiduciary to get appraisals, but we're a little bit unique in that we tell our investors we have our own methodology of value, and you will see that laid out, and it is often much more punitive than an appraisal. And this has been through our entire history because we believe it's our job to underwrite the asset and to tell you what it's worth. And if the appraisal comes in lower, then let's talk about it. That hasn't really happened. And so we have been fortunate that we've had value cushion on most of our projects. And so those deals that are higher LTV, we'll look at them, but there is no doubt that many projects need a basis reset. They need sponsors to inject capital to bring down the loan to value. It's going to have to happen.
Really? Okay. So that actually does dovetail into my penultimate question. That is, what do you think is going to happen? So we date stamp this. It is July 23. What's going to, yeah, you love that, don't you? So, but over the next 6 to, let's say, 18 months, what do you think, what are you seeing in multifamily, particularly over that?
Am I allowed to be a two-handed economist or no?
I'm not sure what that means, but yes,
yes,
whatever it is, yes.
It might go up and it might go down. Am I allowed to do that?
Yes and no.
Yes and no.
That case.
I don't. It's funny. In spite of everything, I'm actually a glass half full person, and I really think that in 9 times out of 10, good people that roll up their sleeves in challenges will find an outcome, and it might not be the perfect outcome, but they can get to a good outcome, or at least an acceptable outcome. I think we will see that in multifamily for the most part. I think the cracks will happen on projects and sponsors whose business plan at the outset probably wasn't great, and they needed perfection on their business plan and some other things, right? Like rent growth and some other stuff that they can't even control. I think a meaningful percentage of those folks are going to be in trouble. So is there going to be a massive wholesale sale in multifamily and values drop, 40%? No. But I do think we'll see distress. I do think in every market, we're going to see sell-offs. I think that we're going to see some folks get hurt and throw the keys back. But net, I think in 2 years, we're going to say this was challenging, but we got through it.
Right. Let me ask you one final question. And that is, what resources do you use, or what sources do you use to stay in tune with what's going on in the market?
So I try to read as much as I can and listen to as many podcasts, much to dismay of my family. I always have like one AirPod in listening to something. And I listen to a whole host of economic podcasts and even technology podcasts, because I think understanding what's happening macroly can be really critical. I think we sometimes get very focused in commercial real estate and lose sight of what's happening more globally. And not that technology will change commercial real estate, but rather the movement of funds and flows in technology and things like that, or healthcare, do change the impact of what happens in commercial real estate, right? Capital moves, and those movements of capital matter. But absent that, my number one resource, candidly, is people. I talk to as many people. I go through my AirPods twice a day. I burn them out. I talk to everyone, and it's leasing brokers, investment sales brokers, it's owners, it's other lenders. I mean, I know probably 75% of the other lenders in the space, and we're friends. We talk about what they're seeing and what they're going through, attorneys. Because, you can read an article in the Wall Street Journal, but it's helpful, but it's just illustrative. I want to know what's going on within my sphere and what's happening to folks around me that I trust.
And what is general sentiment? I said it was the last question, but I lied. What is the general sentiment?
I mean, it's not the most upbeat environment right now. I think that a lot of folks are batting down the hatches and saying it's going to be a tough next 12 months. And general sentiment is that foreclosures are going to start to come through. Attorneys on the litigation side are going to get busy. Investment sales is going to be slow for a minute. And, leasing is going to be challenging. But all of that said, when you talk to enough folks, you also hear how many of their sponsors, or if they're the sponsor, how much capital they actually have, or access to capital. There is a lot of capital out there, and I do think it will buoy a lot of the distress, and it will help prevent a massive decline. And so I think a lot of people are waiting around to see when those big flows of capital come in, and I think we'll see it.
Scott Larson, Managing Principal at Pangea Mortgage Capital. Thank you so much for joining me today.
Thank you for having me. It was a real pleasure. Appreciate it.
All right, that was Scott Larson at Pangea Mortgage Capital talking about his insights as a balance sheet lender with a particular focus on multifamily real estate. If you want to know more about Scott, just go to the podcast page at gowercrowd.com. While you're there, be sure to subscribe to our newsletter. It goes out every Wednesday. It is completely free and it covers the world of real estate syndication and crowdfunding with a focus on what's going on in the market today, particularly in the distressed real estate market. What exactly is happening? Thank you, Scott. Thank you, Scott, actually, for joining me. What a pleasure meeting you. I really enjoyed hearing your insights and do encourage you to join me again sometime, perhaps towards the end of the summer. Who knows where the market is then? And thank you also, dear viewers, for spending your time with us today. I hope you found conversation with Scott as interesting as I did. And that's all I've got for you today. So thanks so much. I'll see you next time. For now, this is Adam Gower signing off.